This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Mark. Every week, I break down the tax rules, the financial traps, and the retirement income threats that nobody else is explaining. Because the system is not designed to tell you what it's costing you. If that sounds like something you need, hit subscribe right now and turn on notifications so you never miss a video. Here's what those 12 states are actually doing to pension income, why the middle class gets hit the hardest, and the 3 moves that can stop the drain before it costs you another year. Mistake 1. Assuming your state is retirement friendly without checking how it treats pensions specifically. This is where almost everyone starts. They hear that their state has no estate tax or that Social Security is exempt, and they file it under I'm fine. The problem is that Social Security exemptions and pension exemptions are 2 entirely different things. A state can protect every dollar of your Social Security benefit and still tax your pension like a W-2 paycheck. Most do not advertise that distinction. Here is what the actual number looks like. A retiree in Minnesota collecting $40,000 in pension income with no applicable exemption faces Minnesota's top income tax rate on that distribution. 40,000 times 9.85%. That is $3,940 per year in state income tax alone before a single dollar goes to the federal government. Now multiply that out. $3,940 times 15 years of retirement. That is $59,100. Most retirees have never seen that number written down. That is the cost of a sentence no one said. The 12 states that fully or partially tax pension income are Connecticut, Colorado, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, and Vermont. If you are collecting a pension in any of these states, you need to know your specific exposure because the rules are not uniform. Some states tax all pensions. Some tax based on source. Some phase out exemptions at income thresholds that hit the middle class directly. What to do right now? Go to your state's Department of Revenue website. Search Pension Income Exemption or Retirement Income Exclusion. Do not Google it generically. Go directly to the state revenue page because third-party summaries are frequently outdated or incorrect. Find out whether your pension type qualifies for any exemption. That is step 1. Mistake 2, hearing my state has a pension exemption and assuming you're covered. This is the trap inside the trap. Because yes, some of these 12 states do offer an exemption. Colorado has one, Missouri has one. But what most retirees do not know is that these exemptions are income tested. They phase out as your total retirement income rises, and the phase out band hits the middle class almost perfectly. Here's how Colorado works in 2026. If you are under 65, Colorado lets you exclude up to $24,000 of pension and annuity income from state taxes. If you are 65 or older, that exclusion rises to $36,000. Sounds useful. Here's where it breaks down. Say you are 62, retired with a $38,000 annual pension. Colorado shields the first $24,000. The remaining $14,000 is taxable at Colorado's flat income tax rate of 4.4%. $14,000 times 4.4% equals $616 per year. That does not sound like much on its own. Over 20 years, it is $12,320. For a couple who thought they had an exemption and assumed they were fine. Now add the cascade. That same retiree is also collecting Social Security. In Colorado, Social Security is deductible for taxpayers below certain income thresholds. But the pension income pushes their combined total up, potentially reducing or eliminating the Social Security deduction too. One miscalculation compounds into 2. What to do? Pull your state's current exemption threshold. Compare it to your gross pension income, not your net, not what hits your bank account, but the gross distribution before any withholding. If you are within $10,000 of the phase-out ceiling, your real exposure may be higher than you think, and it is worth having a CPA verify exactly where you land. Mistake 3, treating all pension income as the same type. Here is the part nobody mentions, and it is the reason two retirees can live in the same state, collect the same dollar amount in pension income, and owe completely different amounts in state tax. The difference is not how much they earn. The difference is where the pension came from. Multiple states draw a legal distinction between public sector pensions, meaning pensions from a state or local government job, and private sector pensions from a corporate employer. In some states, government pensions are fully exempt. Private pensions are fully taxable. Same state, same income. Opposite tax outcomes. Let me put real numbers on this. In Connecticut, a retired teacher with a $40,000 state pension may owe zero in state pension tax. A retired sales manager with a $40,000 private pension from a manufacturing company owes Connecticut income tax on the full amount. Connecticut's income tax on that distribution at a rate of 6.99% is $2,796 per year. The teacher next door pays nothing. That is not an edge case. That is the rule. And it applies in multiple states, including Missouri, which fully exempts certain public pensions while subjecting private pensions to its standard income tax rates. Military veterans face an additional layer of confusion here. Federal military retirement pay is treated differently in almost every state. Some states exempt it fully, some partially, some not at all. A veteran moving to a new state who assumes their military pension gets the same treatment as a state government pension is often wrong. What to do? Before you rely on any retirement-friendly characterization of your state, identify the exact source of your pension: public, state, or local government. Federal civilian, military, private employer. Look up that specific category in your state's revenue code. The general headline about your state's tax environment does not apply unless you verify it applies to your pension type. Mistake 4. Moving to a new state without checking pension tax rules before establishing domicile. Retirement relocation is one of the biggest financial decisions a retiree makes, and in almost every conversation about it, the focus is on cost of living, proximity to family, and housing prices. State income tax on pension income almost never comes up until the first tax bill arrives. Here is where it becomes irreversible. The moment you establish legal domicile in a new state, change your driver's license, register your vehicle, register to vote, you are that state's taxpayer. Proving you have left for tax purposes after the fact is a legal process that many retirees do not know they need to undertake. And the state you moved from may continue to assert taxing authority if your ties to it remain strong. Let me give you a specific example of what this looks like in dollars. A retired nurse spends her career in Texas. No state income tax. Her pension is $48,000 per year. She decides to move to Minnesota to be near her daughter. She buys a condo, updates her license, registers to vote. Before the move, zero in state income tax. After the move, Minnesota taxes pension income. On a taxable portion of her $48,000 pension at a rate of approximately 9.85%, her annual state tax bill is roughly $4,728. Same pension, same person. One address change, $4,728 per year. Over a 15-year retirement in Minnesota, that is $70,920 in state tax she would not have paid had she moved to Wisconsin, Illinois, or Iowa instead, all of which are closer to the Twin Cities than Texas. What to do? Before you sign a lease, buy a home, or update a single piece of government ID in a new state, look up that state's pension income tax rules. Go directly to the State Department of Revenue website. Search your pension type specifically. This takes 20 minutes and could save you 5 figures over a decade. Mistake 5. Missing the Roth conversion window before your pension income begins. This is the mistake with the most expensive long-term cost, and it is the one that is hardest to undo. Because once your pension starts, the conversion math changes permanently. Here is what happens. Say you live in Minnesota, and you have $400,000 sitting in a traditional IRA. You plan to retire at 65 and start your pension at 66. In the year before your pension begins, your taxable income is low. Maybe you are living on savings. Maybe you have some part-time income. Your Minnesota marginal rate on IRA income that year might be 5.35%. The year your pension starts, everything changes. Your $48,000 pension pushes you into Minnesota's higher bracket. Now, any IRA dollars you convert to Roth in the same year stack on top of that pension income. Your Minnesota marginal rate on those conversion dollars, 9.85%. Let me put the difference on the table. $50,000 converted to Roth before the pension starts. 50,000 times 5.35% equals $2,675 in state tax. The same $50,000 converted after the pension begins. 50,000 times 9.85% equals $4,925. That is a difference of $2,250 on a single conversion. Now run 3 consecutive years of $50,000 conversions at the higher rate instead of the lower one. That difference totals $6,750 in unnecessary state tax, paid on a timing decision, not a dollar amount decision. The conversion amount was identical. The timing was the only variable, and here's the part that changes everything. Roth accounts do not require distributions during your lifetime. Every dollar you convert before your pension starts and before you hit your peak state marginal rate is a dollar that will never face state income tax again in Minnesota, in Colorado, in Connecticut, or anywhere else. What to do? If you are within 5 years of your pension start date, schedule a conversation with a CPA who will run the state tax math, not just the federal numbers. Ask them specifically to model annual conversions of $40,000 to $60,000 in the years before your pension begins. The window to do this right is narrow. It closes the day your first pension check arrives. Now the strategies. 3 specific moves that directly address what we just walked through. Strategy 1. Verify your state's pension classification and exploit every exemption that applies. This sounds basic. Most retirees have not done it. Go directly to your state's Department of Revenue website, not a financial blog, not a tax prep software FAQ, and locate the official guidance on retirement income. Identify which exemptions exist, which income thresholds trigger the phase-out, and whether your specific pension source qualifies. If you're already paying state tax on pension income, verify that the withholding amount is correct. Many pension administrators use generic withholding estimates that do not reflect the actual exemption your income qualifies for. A small correction here can free up several $100s a year with a single phone call to your pension administrator. Strategy 2. Execute a Roth conversion ladder before your pension begins. If you are within 5 years of your pension start date and you are sitting on a significant traditional IRA or 401k balance, this is the most valuable move available to you. Model annual conversions of $40,000 to $60,000, enough to move money out of your pre-tax account without pushing you into your top state marginal rate for that year. The goal is to convert at the lowest rate you will ever face, which is almost always before the pension starts and before Social Security begins. A CPA who understands your state's marginal rate schedule can tell you the exact dollar amount to convert each year to stay below the threshold. This is not complicated math. It is math that requires someone to run it with your specific numbers. Strategy 3. Establish domicile in one of the 14 states that exempt pension income entirely. If your pension exceeds $35,000 annually and you have flexibility in where you live, relocation is the most powerful single move on this list. The 14 states that offer complete pension income tax immunity include Florida, Texas, Nevada, Wyoming, Washington, South Dakota, Alaska, Tennessee, New Hampshire, Illinois, Mississippi, Pennsylvania, and Hawaii. Hawaii taxes pensions from outside the state, so verify your specific situation. Establishing legal domicile is a specific legal act, not just a mailing address. To do it properly, update your driver's license and vehicle registration in the new state, register to vote there, open a local bank account, and spend more than half the year there. If your prior state is aggressive about domicile disputes, and states like Connecticut and New York are, consult a tax attorney about the steps required to formally sever taxing ties. This is not a step to take informally. This is Mark. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who is drawing a pension in one of these 12 states, send them this video today. Drop a comment. Which state are you in, and did you know your pension was taxable there? I read every single one, and the most common situations become future videos. I will see you in the next one.